Hello, I am Cem Oze. Welcome to the weekly Market Notes program. This week, the markets were quite busy and full of surprises. In our program, we will first discuss the inflation data from the US that fell below expectations and signaled a green light for the Fed's interest rate cut cycle, and how this data has propelled the S&P 500 and Nasdaq to record highs. Then, we will turn our focus to Turkey and detail the surprising 100 basis point interest rate cut decision by the Central Bank of the Republic of Turkey, CBRT, and the strong rally it triggered in the BIST 100 index. After analyzing the reasons behind the pullback in precious metals amid increased global risk appetite, we will conclude our program by examining the critical meetings of the Fed, the European Central Bank, and the Bank of Japan next week, which will determine the market's fate. If you are ready, let's begin. This section, as always, highlights the most shocking developments of the week that will instantly draw you into the heart of the market. This week, our headlines feature two critical data points and their reflection on the markets. First, the US September headline CPI data was announced at 0.3%, contrary to the expected 0.4%. This unexpected slowdown in inflation strengthened expectations that the Fed is close to cutting interest rates and pushed the S&P 500 index to an all-time high close of 6,791.69 points. In Turkey, all eyes were on the Central Bank of the Republic of Turkey. The CBRT cut its policy rate by 100 basis points to 39.5%. Contrary to market expectations, this decision triggered buying in Borsa Istanbul, and the BIST 100 index surged by an impressive 8.6% week over week, reaching 10,941.79 points. We are now beginning to analyze in more detail the reflections of these two major developments on global and local markets. In this section, we will analyze the key macroeconomic dynamics in the US and Europe that determine the direction of global markets and their impact on investor risk appetite. Undoubtedly, the most important data of the week was the September Consumer Price Index, CPI, from the US. Let's detail the figures. The headline CPI monthly expectation was 0.4%, but it came in at 0.3%. The annual figure was 3.1% compared to the expected 3%. The core CPI monthly figure was 0.2%, expectation 0.3%, and the annual figure was 3% versus the expected 3.1%. These figures indicate that the disinflation process is ongoing. Disinflation, simply put, means a slowdown in the rate of inflation or a slower increase in prices. Looking at the subcategories of the data, we see that this slowdown is spreading across the board. Notably, the deceleration in housing costs, the equivalent rent of homeowners category, has fallen to its lowest level since January 2021. Additionally, the decline in used car prices and the lowest level of services inflation since November 2021 are other significant developments easing the Fed's stance. The market interpreted these data as a green light for the Fed to cut interest rates by 25 basis points at its meeting next week. Expectations are focused on a total of 2 more rate cuts by the end of the year. While this situation positively impacts risky assets like stocks and cryptocurrencies, it has also increased investors' risk appetite. Positive signals regarding economic activity have emerged on the European side. The Eurozone composite PMI data exceeded expectations in October, rising from 51.2 to 52.2, reaching the highest level in 17 months. While the services PMI indicated growth at 52.6, the manufacturing PMI remained at 50, showing a stagnant trend. These data suggest that the European economy is moving away from recession and provide a sufficient basis for the European Central Bank, ECB, to keep interest rates unchanged for a while longer. The incoming data seem to support the soft landing scenario by central banks. Controlling inflation without entering a recession is the most ideal scenario for markets. However, US-China tensions and geopolitical risks are still on the table, and this optimism could be disrupted suddenly. Let's move on to the S&P 500 section to examine how this positive global sentiment is driving US stock markets to record highs. In this section, we will analyze the recent performance of the S&P 500 index, the leading indicator of the US stock markets, its technical levels, and the market breadth that indicates the overall health of the market with figures. The index closed the week at a historic high. On Friday, the S&P 500 reached an all-time high closing of 6,791.69 points, with an increase of 0.79%. Let's look at the weekly performance of the index with figures. The index closed the week at a historic high of 6,791.69 points. Our medium-term primary support level is at 6,700 points. Above that, our first resistance targets are at 6,800 and 6,170 points. Market breadth data provides important clues about the future rally. Only 52% of the companies in the index are above their 50-day moving average, and 66% are above their 200-day moving average. These ratios are significantly below the peaks of 80% and 77% in 2024. This situation indicates that the rally has not yet spread to all shares and that there is potential for continued upward movement. To see how critical the role of technology stocks is in this increase in the S&P 500, let's now move on to the Nasdaq analysis. In this section, we will discuss the record performance of the Nasdaq index led by technology giants, the artificial intelligence theme that triggered this rise, and key technical levels. The technology-heavy Nasdaq index closed the week with an impressive increase of 1.15%, reaching 23,204.87 points and marking a new high. There are two main dynamics behind this rise: mega technology companies and the artificial intelligence theme. Expectations for earnings reports from major companies like Microsoft, Apple, and Amazon, which are expected next week, increased investor optimism, leading to strong buying in the index. At the same time, we see that the artificial intelligence theme remains vibrant. The emphasis on continued demand for NVIDIA chips during Tesla's teleconference and Intel's positive outlook for 2026 demand were significant developments supporting this theme. Technically, the 24,750 to 25,000 point range for the Nasdaq 100 index stands out as a critical support zone. As long as this level is maintained, the positive trend is expected to continue. On the upside, the first resistance level is at 25,750, and if this level is surpassed, 26,100 points will be monitored as resistance. Although the rally in Nasdaq seems to be supported by just a few large companies, the theme of artificial intelligence is now transforming not only technology, but also every sector from retail to industry. Therefore, focusing on thematic strength rather than market breadth might be more appropriate. Now, let's take a look at US bonds to see how this enthusiasm in the stock markets is reflected in the bond markets. Now, we will evaluate the impact of the Fed's interest rate policy expectations on the US bond market and the overall trend. This week, instead of focusing on specific bond yield figures, we will concentrate on the general trend created by market expectations regarding the Fed. The lower than expected inflation data and the anticipation that the Fed will soon start cutting interest rates are exerting downward pressure on bond yields. As you know, bond yields and bond prices are inversely related. That is, a decrease in yields increases the price of existing bonds. This situation makes the bond market more attractive to investors and also supports overall interest in US assets. The bond market prices in the Fed's next move before anyone else. The current calm indicates that the market has largely priced in a rate cut cycle. The main question will be the speed and magnitude of the cuts. Any surprise could lead to sharp movements in bonds. Let's see how these expectations in the bond market affect commodity markets that offer interest-free returns, especially gold. In this section, we will analyze the impact of the increased global risk appetite on safe haven precious metals and their technical levels. Throughout the week, record highs in the stock markets led to profit-taking in precious metals. At the beginning of the week, gold per ounce traded at around $4,200, but by the end of the week, it declined to $4,111.56. The technical support zone is between $3,195 and $3,944. As long as this level holds, the positive outlook may continue. The first resistance above is in the $4,125 $4,186 range. If this threshold is surpassed, $4,381 could become the new target. Similarly, silver also rapidly lost value and fell to around 48.6. This is the lowest level since October 6th. Technically, as long as the support at 45.79 holds, the positive outlook may continue. Above, resistance bands at 48.9, 49.4 and 50.5, 51.3 can be targeted. So what were the main reasons behind this decline? We can summarize them in four main points. First, risk appetite. Record highs in US stocks shifted investors from safe havens to risky assets like equities. Second, ETF outflows. Large withdrawals occurred from gold and silver ETFs. Third, dollar and interest rates. The calm movement of the dollar index and expectations of falling bond yields reduced the attractiveness of gold, an asset without interest. Finally, geopolitical developments. The decrease in geopolitical tensions in the Middle East became another factor weakening safe haven demand. There is a notable dynamic in the silver market. The decline in stocks at the London Bullion Market Association, LBMA, and the high leasing rates of around 20% indicate a supply shortage in the physical market. This should be noted as a factor that could support silver prices in the medium term. This decline in precious metals is a classic example of a risk-on rally reflecting risk appetite. However, when the Fed's rate cut cycle begins, the decrease in real yields could give a tailwind again for gold and silver. Let's examine how the week has gone in the cryptocurrency market, another indicator of risk appetite. In this section, we will discuss the recovering cryptocurrency market in line with the optimism in global markets, the performance of leading cryptocurrencies, Bitcoin and Ethereum, and their technical levels. The leading cryptocurrency Bitcoin reached $111,400, surpassing a 2% increase during the week, marking the highest level in recent weeks. This rise was supported by expectations of spot ETF approvals and approximately $20 million in net inflows into funds in the last 24 hours. Technically, $111,500 is an important resistance. If this level is surpassed, the target range could be $112,800, $114,000. During pullbacks, the support will be monitored in the $110,500, $109,800 range. Ethereum also rose to $3,180, approaching the critical $4,000 threshold. However, a different dynamic is at play here. Recent outflows of $128 million from institutional ETFs limited the price increase compared to Bitcoin. Technically, maintaining above the support zone of $3,950, $4,000 is important. If this is achieved, the target range can be between $4,050 and $4,120 USD. Ripple closed the week with a sideways movement around 244 and maintained its support between 240 and 242s. The crypto market is becoming increasingly sensitive to macroeconomic data. The most evident indicator this week was that Bitcoin is behaving more like a risky asset, such as technology stocks, rather than the narrative of digital gold. After this journey in global markets, we turn our focus to Turkey and look at the developments here. On the positive side, Turkey's risk premium has decreased. Although the main factor is the increase in global risk appetite, this improvement is also supported by the rise in CBRT's reserves and the Fed's interest rate cut expectations. With these developments, Turkey's 5-year CDS premium decreased by approximately 15 basis points during the week to 252. However, it should be noted that this level remains high compared to similar emerging markets. For example, during the same period, Brazil's CDS is at 145 basis points and South Africa's is at 163 basis points. The numbers tell a two-sided story. On one hand, the declining CDS reflects an improved perception of external risk. On the other hand, foreign capital is not yet convinced, and domestic investors are cautiously interested in foreign exchange. Without narrowing this spread, a lasting relief in the market is unlikely. Let's examine how this overall outlook is reflected in Borsa Istanbul and the dynamics that brought about this week's record. In this section, we will detail the strong rally experienced in Borsa Istanbul following CBRT's surprise interest rate decision, the performance of the index, and the key technical levels. The BIST 100 index ended the week with a very strong rise. On Friday, the index increased by over 3%, closing the week with a gain of approximately 8.6% at 10,941.79 points. Leading this impressive increase was the banking index, which experienced a weekly rise of 12.8%. So, what was the main driver of this rally? The answer is clear. The Central Bank of the Republic of Turkey cut its policy rate by 100 basis points from 40.5% to 39.5%. This move, which was outside market expectations, directly boosted the stock market. Let's take a look at the technical report card of BIST 100. The index closed the week at 10,941.79 points, achieving a weekly return of 8.6%. During pullbacks, the 10,700-10,800 range will be watched as a strong support zone. Above that, the 11,100 range tested during the week appears as the most important resistance zone in the short term. Let's examine the other effects of the CBRT's decision behind this enthusiasm in the stock market on the exchange rate, interest rates, and CDS. In this section, we will analyze CBRT's interest rate decision, which is the most critical internal development of the week, and its multifaceted effects on the USD-TRY exchange rate, treasury bond yields, and Turkey's risk premium. CBRT Monetary Policy Committee lowered the policy rate by 100 basis points from 40.5% to 39.5%. This decision surprised the market by deviating from the general expectation of a 150 basis point cut or a hold. This indicates that CBRT's interest rate cuts are becoming smaller. The emphasis on risks related to the disinflation process, especially the rise in food prices in the MPC statement, was also interpreted as a sign of a cautious stance. Now, let's look at the market reactions to this decision. Despite the interest rate cut, we observed that the USD-TRY exchange rate remained relatively stable. The rate, which fluctuated around 42 TRY during the week, closed at approximately 41.95. This relatively horizontal trend in the exchange rate is attributed to CBRT's strong reserve accumulation and the deterrent effect of possible foreign exchange sale interventions in the market. The EUR-TRY traded at around 48.8. Following the decision, there was some selling pressure on TRY-denominated bonds. Although the 10-year Treasury bond yield rose to 31.8%, it closed the week with a 9 basis point decrease from the previous week at 31.84%. As previously mentioned, Turkey's 5-year CDS premium decreased by 15 basis points during the week to 252, in line with global risk appetite. CBRT shows that the central bank is trying to strike a delicate balance between slowing down the pace of interest rate cuts and supporting growth without disrupting the price stability message. The currency remaining calm suggests that the market is currently tolerating this move, but it also indicates that credit remains limited until the next inflation data. These were the developments that influenced the markets this week. Now let's take a look at the critical data we need to monitor next week. Next week, we are expecting a very important economic calendar that could influence both Turkey's and the global markets. Let's take a look at the data and events we need to follow chronologically. In Turkey, the unemployment rate, which will indicate the health of the labor market, the real sector confidence index, which signals the pulse of industry in terms of production and investment appetite, and the September foreign trade deficit data, expected to be around $6.9 billion, which is significant for the current account balance and foreign exchange needs, will be monitored. Due to Republic Day on October 29th, the markets will be closed for a day and a half. Trading volumes may decrease towards the end of the week. In global markets, the Fed interest rate decision with a 25 basis point cut expected. If the expectation is met, it could support risk appetite. The European Central Bank interest rate decision, no surprise expected, statements will be important, and the continuation of the negative interest rate policy expected from the Bank of Japan will be followed. The APEC summit will take place on October 31st, November 1st. US-China meeting could send future messages regarding trade tensions that may influence market direction. As you can see, next week will be quite busy with central bank decisions and the Leaders Summit. Don't forget to subscribe to our channel and like our videos to stay informed about market developments. See you next week. I wish you a profitable week.